At 30, you stand at the most critical junction of your financial life. You want $40,000 in monthly dividends, but the path ahead is littered with traps. If you rely solely on traditional high-dividend ETFs, you are making a losing trade. You are essentially bartering your youth for a retirement that only arrives at 60. Look at your portfolio. Is it moving, or is it merely existing? Many investors gamble everything on a single semiconductor stock, hoping for a miracle, while others hide in stagnant funds, watching inflation erode their purchasing power. Both paths lead to the same dead end. Decades of waiting for a finish line that keeps moving further away. You are currently trapped between bad advice and the fear of risk. You want freedom, but you are settling for a slow crawl toward a distant horizon. The math is cold and unforgiving. If you continue to play it safe, you will never generate the momentum required to reach your goals early. The status quo is not a strategy. It is a delay tactic. It is time to stop trading your best years for a future that is not guaranteed. You need to change the engine, or you will never reach the destination. The solution is not a miracle. It is a calculated, twin-engine strategy designed specifically for the 30-year-old investor. You stop playing defense and start building an engine that works while you sleep. This approach blends aggressive semiconductor growth with steady dividend yields. It is the only way to ensure your assets triple within a single decade. Think of your capital as a machine. One engine provides the raw, explosive power of market leaders, while the other provides the consistent, reliable fuel of dividends. Most people fail because they only use one. They either chase high-risk gambles that burn out, or they park their money in funds that never move. By combining these two forces, you create a compounding effect that accelerates your timeline. You are not just saving, you are engineering a fortune. This is not about luck. It is about replacing stagnation with a dual-purpose system that captures capital gains while maintaining a baseline of cash flow. If you want to reach $40,000 in monthly dividends, you must stop hoping and start executing. This is the blueprint for your next 10 years. The transition starts now. The first pillar of this strategy is the golden ratio of asset allocation. At 30, safety is a trap. It is a comfortable lie that keeps you poor while you think you are being responsible. You need an attacking force. If you spend your 30s protecting what little you have, you will never build the capital base necessary to sustain a high-income future. You must stop viewing volatility as an enemy and start seeing it as the price of admission for exponential growth. This shift in mindset is the hardest part of the process. You are conditioned to seek the security of low-yield funds, but that security is exactly what is killing your potential. To triple your assets, you must pivot toward growth leaders. You are not looking for stability. You are looking for momentum. Your portfolio needs to be aggressive, lean, and focused. The golden ratio is the bridge between where you are and where you need to be. Safety is for the end of your journey. With a $60,000 monthly investment capacity, you must be precise. You are not just buying stocks, you are building a system. Direct the majority of your capital into growth leaders like TSMC or semiconductor-heavy indices like 00850. These are your engines. They provide the raw, kinetic energy required to push your net worth into a new bracket. They are volatile, yes, but they are also the primary drivers of global wealth. The remaining portion of your capital goes into high-dividend ETFs. This is your defensive shield. It does not exist to make you rich overnight. It exists to provide a baseline of cash flow that keeps you in the game when the market turns. This balance is critical. If you ignore the engines, you lose the growth. If you ignore the shield, you lose the stability required to hold through the inevitable corrections. You are creating a portfolio that captures massive capital gains while simultaneously building a foundation of recurring income. It is a calculated, mechanical approach to wealth that leaves no room for guesswork. You are now the architect, of your own financial velocity. Now, look closely at the trap that catches most investors. If you focus only on the shield, you are choosing a slow crawl toward a finish line that keeps moving further away. You might see the monthly payouts hit your account, and it feels like progress. It is not. It is a distraction. By prioritizing dividends over growth, you are effectively trading your potential for a false sense of security. You are building a wall, but you are failing to build the house. If you rely solely on high dividend funds, you lack the raw momentum required to reach your goals in your 30s. You are playing a defensive game when you should be on the offensive. The math is unforgiving. Without the explosive capital gains from growth leaders, your portfolio will never generate the velocity needed to hit that $40,000 target early. You are essentially paying for comfort with your most valuable asset, time. Every dollar you lock into a stagnant dividend fund is a dollar that is not working to triple your wealth. You are not just missing out on gains. You are actively slowing your own progress. Stop chasing the immediate gratification of a yield check. Start chasing the growth that creates a fortune. If you want to retire before 60, you must abandon the safety of the shield and embrace the volatility of the engine. The choice is yours. Stay comfortable and work forever, or take the risk and buy your freedom. Now, we turn to the second pillar, the relentless power of dividend compounding. This is where most investors hemorrhage their future wealth without even realizing it. You receive a dividend payment. If you treat that money as extra cash to spend, you have just broken the cycle of growth. You have effectively stopped your money from working for you. The math is simple, yet it is transformative. Every single cent you receive in dividends must be immediately funneled back into your growth engines. Do not let it sit in a stagnant account. Do not let it vanish into your daily expenses. You must force that capital to acquire more shares of the world's most valuable companies. Think of your dividend check as a seed. If you eat the seed, you satisfy a hunger for a moment. If you plant the seed, you grow a forest. By failing to reinvest, you are choosing to stay small. You are choosing to let your timeline stretch out toward an impossible horizon. Stop the leak. Start the cycle. Reinvest every cent. Or accept that you are choosing to work for decades longer than necessary. Now, witness the math that changes everything. This is the snowball effect in its most violent, productive form. When you reinvest those dividends, you are not just adding to your pile. You are creating a feedback loop that feeds on itself. Every share you buy today generates a dividend tomorrow, which buys another fraction of a share, which generates more dividends the month after. It is a machine that never sleeps. Look at the timeline. If you rely on passive growth alone, you are looking at 15 years of waiting. But apply this compounding engine and watch that horizon collapse. You slash that 15-year slog down to less than 10. You are reclaiming 5 years of your life. 5 years of freedom that you would have otherwise spent chained to a desk. This is the epiphany. You are using the market's own capital to buy your future. You are a builder of a financial fortress. By the time you hit that 10-year mark, you are crossing the finish line with enough velocity to sustain $40,000 monthly. Now, we reach the final pillar, dynamic discipline. This is where the amateur falters and the professional thrives. You have built your engine, but an engine requires maintenance. As your career peaks and your income rises, you must resist the siren call of lifestyle inflation. Every extra dollar you earn is not for comfort, it is for fuel. You must scale your contributions with the same intensity you used to start. Be ruthless with your portfolio. If a holding underperforms, if it drifts from your core growth strategy, or if it shows signs of stagnation, you must cut it. Do not hesitate. Do not hope for a turnaround that never comes. Hope is not a strategy. It is a liability. You do not need a dozen funds cluttering your account. You need a few powerful, high-efficiency engines working in perfect, brutal harmony. If a position is not actively accelerating your path to that $40,000 monthly goal, it is dead weight. Strip it away. Growth comes first. Dividends are the shield, but growth is the sword. Keep your blade sharp, keep your portfolio lean, and never let sentimentality cost you your freedom. You have the blueprint. You have the pillars of growth, the engine of compounding, and the discipline of a professional. The theory is complete. Now, the only variable left is you. This is not a dream you watch from the sidelines. It is a machine you must build with your own hands. The market is open, the engines are primed, and the path to $40,000 a month is clearly marked. Do not let this information sit idle. A strategy without execution is just a thought. You have $60,000 of monthly capacity to master. If you are ready to launch your recurring investment plan, if you need clarity on how to split your capital, or if you have a specific hurdle standing in your way, leave a comment below. I want to see your commitment. This is your moment to stop being a spectator and start being an operator. Subscribe to this channel to stay on track as we refine these engines. Share this video with someone who is currently wasting their youth on stagnant funds and needs to wake up to the reality of early retirement. You have the tools. You have the timeline. Now, you have the command. The market waits for no one. Start your execution today. I will see you in the next video, where we continue to sharpen our edge. Go to work.